Joining us once again for Wenzel's Weekly Wrap is Mark Wenzel from the Hopkins Group. Good afternoon, Mark.
G'day, Michael. How are you?
Good, thanks, mate. Now, we see the US inflation data showing the headline inflation is starting to slow.
Yeah, it is. So it's slowing with a 12-month rate of 7.1%, coming basically in line with market expectations. This has resulted in the market expecting fewer rate rises to bring inflation back under control. So the cooling inflation was on the back of gasoline, medical services, travel and electricity prices starting to come down, obviously after a hot period during COVID. But the food was the largest contributor to net CPI, with rent being the second. And this has led market participants to conclude that the worst of inflation is behind us and that we are inside of peak interest rates. For me, though, the worry in the numbers in the US is that inflation is coming from the services sector, where previously it was coming from goods inflation, from supply chain issues, obviously Ukraine, rising prices. But with service inflation, that's driven by wages growth. And, for the second month in a row, we've sort of seen, higher than expected wages growth of this month was 0.6%, which was sort of twice the consensus forecast. And, again, I'll speak about the Australian jobs later on, but in the US, the wages growth was accompanied by really robust job gains. And for every job applicant that's out there, there's 1.7 jobs available. So, this indicates to me that we need to be a little bit cautious about potential further market rallies from here. One is that inflation may not have peaked, and two, we've had the Federal Reserve release that their monthly figure last night of a 0.5% increase in interest rates. But they also flagged it at that time that, interest rates in the US particularly and are likely to stay higher for longer. So, again, just some caution around that about sort of getting over exuberant about, any start of any new bull market.
Yeah, also the big local news again, although it's not that unfamiliar, ASIC taking action against another 11 current and former directors of SAR Entertainment Group.
Yeah, absolutely. And while perhaps it doesn't grab sort of some of the headlines, I guess, of company reporting, I mean, this is a really big one for Australia and Australian corporate governance. And, it's a landmark case that the ASIC, Australian Securities and Investment Commission, argues, that boards should be aware of foreseeable risks. So, they allege that the breach of duties arising from Star's dealing with Sun City, who were a junket operator, and that the response that KPMG, they had a report that flagged possible non-compliance, was enough for the directors to, require further investigation into the business and into the risks associated for the business. And obviously the directors didn't do that. So ASIC Chairman Joe Longo highlighted that the directors ought to be exercising due care and diligence in making proper inquiry to the risks that go to the core business. And ASIC rarely make examples of directors in such a high profile manner as they have on this occasion. I mean, it's a clear signal to the market that a poor culture and governance won't be accepted anymore. The action against Star could be a build-up of frustration from ASIC after it failed to execute cases against Crown and the directors of big banks during the Hayne Royal Commission. But again, it's just that clear symbol to Australian directors that, they need to be on top of the risks and that they need to be making sure that compliance, with ASIC policies is put in force.
Now, CSL continues to get some good mileage out of its CEOs.
Yeah, doesn't it just? I mean, again, I've obviously been following CSL since basically my time started in the industry, but didn't sort of realise that they appointed only their third CEO in 32 years this week, with American executive Paul McKenzie taking up the role, and he'll be based in the US. CSL has been a wonderful success story for the Australian share market and a real winner for investors. And for me, taking away the lesson that, really good quality businesses that compound, and it's easy to look in hindsight and identify them. But CSL has returned investors, over 35,000% over the time that it's been listed since 1996, compared to 256% return of the broader market. And again, it highlights the benefit of buying quality companies that can compound their returns and reinvest back in the business to generate successful returns for shareholders. While it's easy, as I say, to point out in hindsight, there is the benefit of compounding and keeping, stocks that you believe do have competitive advantages, even through times of difficult times. And I guess, now's probably a good example of that. And while, it's only sort of general advice, and perhaps you should seek, professional advice about these ones, but there's a potential couple of compounders that are out of favour at the moment, and they might include companies like accounting software provider Xero, Megaport, which provides portal connectivity globally, Macquarie Bank, and REA Group, which owns realestate.com.au. And these are share prices of companies that have come back a long way from their highs during the current market environment, but could have really long-term sustainable competitive advantages. Before we go, sorry, Michael, just the jobless report was reported this morning as well. And, in Australia, we added 64,000 new jobs to the workforce in November, certainly a lot higher than what the forecasts were, which again indicates, similar to the US, that there's extreme heat in the jobs market. And, again, possibly from my point of view, may indicate that I was wrong, sort of reporting last week or a couple of weeks ago that the Reserve Bank should be on hold potentially early in the new year. And it sort of highlights that, again, the same thing in the US, that maybe interest rate rises are going to be higher than what sort of originally thought, but also that they're going to stick around for a long time. Higher interest rates are going to be around for a lot longer than what people expect.
Now, I want to put you on the spot, Mark. The government's intervention into the energy market, flawed,
Yep.
Good. What do you think will happen? With Shell already flagging that they're not going to play.
Yeah, it's dangerous. I think government intervention in public markets, is never a good thing, in that case. And, obviously also it's been flagged that potentially the takeover offer for Origin Energy sort of comes under question as well. So, it just government intervention just, creates grey areas within the market, and market participants don't like that. And obviously, while it's great for consumers if the price comes down temporarily, they can't manipulate the price forever. And as I say, it puts economic investment decisions under risk as well. So generally, from my point of view, it's a bad thing, even though, as I say, it will provide some relief for consumers with high energy prices.
Yeah, and could damage our superannuation.
Absolutely. Again, superannuation funds are the largest shareholders in all of these companies. That sort of brings into question that. And again, it just brings into question for directors of those companies, again, being prudent. They won't want to be making, investment decisions long term if the government's going to be intervening in the market and limiting the return on investment that they can make on the capital that they invest.
Those unintended consequences are some of the biggest consequences.
Massive. And but again, I think from an energy point of view, we've had really bad policy for a long time, and that's why we're getting high prices and we shouldn't be.
All right, Mark, thanks again for your time. One more to go before we break for Christmas, so we'll see you next week.
I'm looking forward to a nice fancy shirt from you next week.
We'll be there, Mark. Thank you.
Thanks very much.